I think a lot of those moves are driven really by relative value at the moment. I think the point is that all of those assets are assets that we think look, reasonably priced in a quite expensive world, and we take that theme over into risk assets as well, in that we prefer long short exposure to pure long exposure. We'd rather try and get equity alpha rather than beta, and even within equity beta, the thing that worries us, I guess, most of all, is that there are some assets that are really priced for absolute perfection, and they just keep getting more expensive on things like vaccine news. So we look at the momentum stocks, which are really the ones that have driven the S&P 500, say, this year, but also all country world index as well, and they just look so egregiously expensive to us. It's hard for us to see that there's a lot more upside in those, and there's a huge amount of downside if things aren't as absolutely perfect, as absolutely Goldilocks as the price of momentum stocks implies. So really, it's more about looking for where there's value rather than making an absolute call, specifically that something is going to happen in 2021. We don't know, but we wouldn't want to be holding assets that are priced for perfection in such an uncertain environment.
Paul, as you know, the consensus seems to be pooling around the idea that there is some kind of post-lockdown burst of demand activity that ultimately improves the earnings profile of a lot of corporates, but gives the markets another window for gains through at least the first and the second quarter of next year. Why do you not buy into that thesis? Because if you don't trade that, then perhaps you're leaving money on the table.
Sure, I'm not saying we don't buy into that thesis, but I think, when you look at that thesis, you break it down, you have to look at who the potential beneficiaries are of that. And for us, it's the kind of stocks that you would associate with high dividend, low volatility, which is one of the most underperforming factors this year. So, it would be utilities, it would be real estate, because we assume that a reopening would create increased utilization of utilities, of real estate. It would be consumer staples. But what we're saying is really avoid the scarily priced stuff, avoid IT, avoid consumer discretionary, because the circumstances, there's such a narrow operating window in which those stocks can continue to go up from where they are now. A lot of them have benefited from the fact that there's been shifts into digital and into e-commerce, into online during COVID. Well, if COVID continues, if lockdowns continue, we don't see that trend continuing. And if it doesn't, well, we don't see how they're going to relatively outperform all the other more boring stocks that have been left behind. You have to look at the fact that out of the S&P this year, the momentum stocks are up sort of 28%. But things like high dividend, low volatility are actually down year to date. So we're just saying, try to avoid the stuff that seems egregiously overpriced, whether that's momentum stocks, whether it's stocks relative to treasuries. Try to avoid the expensive stuff. There is still some cheap stuff out there.